Okay, let's dive in. Celsius Holdings, CELH. Q3 revenue explodes 173%, adjusted earnings beat estimates by 50%, and yet the stock drops nearly 18%. That's the puzzle we're unpacking today, how huge growth can actually trigger market anxiety when it's tangled up with big operational changes.
Yeah, it's a classic growth versus risk story, isn't it? If you just look at the Q3 numbers, I mean, the adjusted ones, it looks fantastic. Revenue hit $725.1 million. That's actually a bit higher than the 715.7 million people were expecting.
Right, so they cleared the top line hurdle easily, but the profitability, that's where things looked, well, almost too good to be true on the surface.
Exactly. Adjusted diluted EPS, 0.42 cents. The forecast was way lower, 0.28. That's a huge 50% beat. And adjusted EBITDA, $205.6 million. Compare that to only $4.4 million last year. It's up, wait for it, 4,573%. Massive jump.
And that reflects the sheer scale they've built now, right? Adding Alani Nu and Rockstar Energy, you're not just Celsius anymore. Suddenly, they're the #3 player in the whole U.S. energy drink space, holding, what, over 20%?
20.8% dollar share in tracked channels, yeah.
Yeah.
They've become a portfolio powerhouse practically overnight. And that scale helped the gross margin too, up to 51.3% from 46% last year. Very strong. But, and this is a big but, the GAAP number, the official reported earnings per share, that was a loss, $2.27 per share.
Okay, that's the whiplash. Huge adjusted profit, actual reported loss. That GAAP loss is tied into all the strategic moves, the acquisitions and integrations.
Precisely. It's mostly non-cash stuff related to the deals, but it looks jarring on the surface and definitely contributed to the stock drop.
All right, let's break down the 173% revenue jump first. Where did all that growth actually come from? It wasn't just people buying more Celsius off the shelf, was it?
No, it was really three things stacking up. First, the obvious one, the acquisitions. Alani Nu contributing for the full quarter and Rockstar Energy for about a month, since that deal closed late August. Second, and this is important context, they were lapping easier comparisons from last year. Remember Q3 2024.
Vaguely. Something about inventory. Remind us what lapping inventory optimization actually means in plain English.
Sure. It just means that in Q3 of last year, 2024, a big customer, probably a major retailer, deliberately slowed down their orders to reduce the stock they were holding. That made Celsius's sales look lower than they otherwise would have been back then. So now in Q3 2025, orders are back to normal or even catching up, making the year-over-year growth percentage look, well, much bigger. And third, yes, there was genuine organic growth from the original Celsius brand itself.
Okay, let's dig into that Celsius brand growth. You said revenue was up 44% year over year. Sounds great. But then you look at the scanner data, what people actually bought in stores, and that was only up 13%. That's a big gap. A 31-point difference between what they shipped and what consumers bought. Doesn't that suggest maybe they pushed too much inventory into the channel?
That's the million-dollar question, isn't it? And sophisticated investors definitely zeroed in on that. Management says that gap is mostly down to two things: that inventory comparison effect we just talked about, the favorable comp, and also running more promotions this year versus last. So yes, it's possible some inventory built up in the system, but the company frames it more as timing noise related to all the network changes happening. It's something to watch for sure.
Makes sense. Okay, now the acquisitions. Very different stories there, right?
Yeah.
Alani Nu seems like a home run straight away.
Oh, absolutely. Alani Nu had a record quarter, $332.0 million in sales. Its retail sales just exploded, up 114% year over year. A lot of that was driven by their limited time offers, their LTOs. They mentioned Witch's Brew specifically. It shows Alani Nu really knows how to create buzz and connect with consumers.
So Alani Nu is firing on all cylinders, but then there's Rockstar Energy, the other big piece they bought.
Yeah, Rockstar is clearly the project. It added about $18 million in sales in its first month, but the underlying trend isn't great. Its retail dollar share actually dropped 0.7 points compared to last year, down to just 2.4%. It's a brand that needs, well, a significant turnaround effort.
So a mixed bag individually. Celsius core growing, but with that shipment gap, Alani Nu rocketing, Rockstar declining. But the overall portfolio picture still looks strong.
It does. Taken together, the whole portfolio's retail sales were up 31% year over year. That's growing almost twice as fast as the total U.S. energy drink category. So it validates their strategy. The more people, more places, more often idea. They are building that comprehensive energy offering for retailers.
Okay, so the strategy seems to be working directionally. But this brings us to the future stuff, the guidance and the strategic shifts that seem to really rattle the market. Let's start with PepsiCo. They've been named PepsiCo's U.S. Strategic Energy Drink Captain. What does that actually mean in practice?
It's a really big deal strategically. It basically cements their partnership and gives Celsius much more say in how energy drinks are managed and sold across PepsiCo's massive distribution network. Think better shelf space controlling the planograms and influencing the overall commercial strategy for the category. It positions Celsius as the go-to expert for PepsiCo and energy. Huge leverage.
And getting that leverage involves a huge operational shuffle, specifically with Alani News,
Correct.
right? Moving his distribution.
Exactly. This is probably the single biggest piece of the forward-looking noise. Starting December 1st, a huge chunk of Alani News distribution is moving over to the PepsiCo system. Long term, that's great. Better reach, efficiency, stability. Short term, it's messy. Really messy.
And that messiness created that massive $246.7 million charge on the books, the one that flipped the quarter to a GAAP loss. Explain that because it sounds alarming.
Right. So, to move Alani New, Celsius had to pay fees to terminate the contracts with its old distributors. That cost totals $246.7 million. But, and this is absolutely critical, PepsiCo is actually footing the bill. PepsiCo is funding those termination fees for Celsius. So from a cash perspective, it costs Celsius nothing. It's cash neutral.
Okay, wait. If it's cash neutral, why does it show up as this enormous loss on the income statement? Why did investors freak out?
Welcome to the wonderful world of GAAP accounting. It's all about timing. The accounting rules say Celsius has to recognize that entire $246.7 million expense immediately in Q3, hitting the P&L hard. But the reimbursement money they get from PepsiCo, that gets treated differently. It gets put on the balance sheet and spread out, amortized, over the whole length of their agreement with PepsiCo.
So it's like they got a free system upgrade, but the accountants make them put the entire demolition cost of the old system on this month's credit card bill, while the payment for the upgrade gets drip-fed into their bank account over years.
That's a pretty good analogy, yeah. It creates this massive artificial mismatch on the Q3 P&L. It obscures the real underlying performance, makes things look volatile, and investors hate that lack of clarity, even if the long-term prize locking in PepsiCo is worth it.
Understood. And that lack of clarity, plus the actual integration work, leads to the company warning about a noisy Q4. What specific problems are they flagging for the next few months?
Yeah, Q4 is expected to be bumpy. You've got the Alani New integration happening, typical year-end stuff like customers managing cash and just general timing effects. Specifically, they warned about pressure on gross margins in Q4.
What's hitting the margins? Just more promotions for the holidays.
Promotions are part of it, yes. But it's also higher costs directly related to the transition, things like inventory write-offs or scrap, and higher freight costs as they physically move Alani New stock into the PepsiCo network. Plus, they mentioned rising tariffs adding some pressure, too. The key message, though, is that they expect this margin pressure to be temporary. They see it normalizing and re-expanding by Q1 2026. And the benefits of the Alani New move won't really kick in financially until Q1 either, because it's a phased rollout, not an instant switch.
Okay, so the market heard. Big accounting loss now, lower margins next quarter. Sell first, figure it out later. Classic. But beyond the immediate Q4 noise, it sounds like they're trying to set up for a stronger 2026 financially.
Definitely. They're shoring things up. Just after the quarter ended, they paid down $200 million in debt. That alone should save them about $20 million a year in interest starting in 2026. And they're bringing in experienced leaders, a new CMO, a president of international, a chief human resources officer. That signals they're serious about managing this bigger, more complex company for the long haul.
Let's circle back to Rockstar for a second. If the goal is this total energy portfolio and being PepsiCo's captain, they can't just let Rockstar keep sliding, can they? What's the plan there?
That's probably the biggest strategic execution challenge they own now, besides the Alani New integration. Revitalizing Rockstar is key. It needs, frankly, a lot. New branding, maybe different flavors, significant marketing investment to make it relevant again. Right now, Rockstar feels a bit dated, especially compared to the newer functional energy drinks like Celsius itself. They need to figure out how to apply their own innovation and marketing playbook to Rockstar, maybe targeting a different audience segment. It's a major undertaking.
Right. So it really boils down to this. They've made huge strategic moves, secured PepsiCo, built massive scale, but the cost is this near-term operational and accounting chaos, plus the big challenge of turning around Rockstar.
Exactly. Investors are essentially placing two bets. One, can management navigate this messy Alani New transition and get margins back on track by Q1 2026 like they promised? And two, can they stop the bleeding at Rockstar and turn it from a drag into at least a stable part of the portfolio? Because that 20.8% share needs all its components working.
Which leads us perfectly to our final thought for you, the listener. Think about this. The overall Celsius portfolio saw retail sales jump 31% in Q3. Impressive. But Rockstar, the brand they just spent significant capital on, saw its own retail sales fall 9% in that same period. Given how much relies on being this strategic energy drink captain with a total portfolio, how much time do they really have to fix Rockstar before the market loses patience with that part of the story? 6 months? A year? How long do you give them to turn that ship around?